Good afternoon, ladies and gentlemen. Very warm welcome to this week's weekly market review. So my name is Benjamin Goh, Head of Research and Investor Education here at SIAS. With us today is our Senior Technical Analyst, Sunny So. As usual, we're going to be bringing you the latest and what we think about the capital markets. First up is, of course, the disclaimer. So SIAS is a registered charity. Whatever we talk about today cannot be misconstrued as a recommendation. So before you take any kind of action in the capital markets, please do see a licensed financial professional. Okay, now before we get into today's content, just to make a couple of announcements, the next Rcr session is on the 17th of May. This is usually we try to hold it on the last or the second last Wednesday for the month in the evening at 7 p.m. This is open only to SIAS members. So please do scan QR code to joke your place, just in case we, make sure that we have enough bandwidth for the Zoom. Now then, of course, the SIAS membership, if you're not a member right now, it is going for $1 per month, $12 per year, which is, I like to say, less than a upsized Burger King meal, which is rather expensive nowadays. If you go to Carl's Jr., obviously it's cheaper than Carl's Jr. So this is again a QR code to sign for the membership. So we do have exclusive events like the Rcr Session, where any member can ask any kind of question to our analysts. Now let's get started. The inflation fight is still going to be a long slog. So as you can see, since June, July last year, energy prices have come down quite a fair bit. So the knee-jerk reaction to Ukraine war in terms of energy, as well as some agricultural products like grains and wheats and all that are coming off. And the energy crisis in Europe didn't come to pass. But that is on hindsight, the easy part, right? So we discussed this about 2 weeks back. The hard part going forward is, of course, the stubbornly high wage inflation. Specifically in the US, the labor market is still quite resilient. We'll be talking about it in a second, which leads to the fact that although you've got energy prices coming down, simply we still have got too much money chasing too few goods. The classic layman definition of inflation. So too many people having too good jobs, paying too high an income, which is a good problem. But obviously, inflation is still far above the Fed target rate of 2%. Now, based on Bloomberg forecasts, the US inflation headline numbers, as well as the core inflation, will still be hovering around 3% at the end of 2024. That's in 18 months, which of course is not going to help a good friend, Mr. Biden's, bid for his second term. Because obviously his poll numbers is even worse than Trump right now, which is a bit odd, but anyway. So this is still going to continue, long fight for inflation. And of course, what happens in the US will impact Singapore. Now, there is some talk about having a soft landing in the US. I think some analysts, as well as even Mr. Jerome Powell, chair of the Fed, is still holding out a candle for a soft landing in the US. So just to put this in perspective, it's been slightly more than a year, about 13 months, since the US Fed has increased the Fed funds rate from close to zero to now 5.25% at the upper bound of the range. So generally what happens is that this is a standard monetary policy tool. So whenever you have got high inflation, you want to, suck liquidity out of the system. So in a sense, higher Fed funds rate, of course, will add up to higher borrowing costs. And therefore, as you can see, asset prices are down. So very specifically, you look at the US equity markets, it's obviously down, right? Now, the real economy impact is that consumption should slow, I beg your pardon. And then, of course, businesses will cut jobs. Now, the challenge here is, of course, the US labor market is still quite resilient. Surprising. But the fact is that if you look at the GDP numbers for the first quarter in the US, it's coming off a little bit, although it's still positive. But what the main, takeaway from the numbers that we looked at was that the business inventories were falling quite fast. All right. So which means that businesses are not building out as much of a product as they would like, simply because probably because they think that we'll be buying less going forward. So we already see the impact already. So the idea here is that a recession is the natural antidote to bring inflation back to target, right? Now, in the last 6 to 7 decades, the number of cases where interest rate hike policy did not lead to a recession, well, it's precisely zero, right? So soft landing, as in skirting a technical recession, probability of that happening based on historical data is of course 0%. All right, so let's put that to bed. We are probably going to be seeing some kind of recession. It's whether or not it's going to be a good, or whether bad, mild, or severe. Now, coming back to the US labor market, non-farm payrolls came out last week for April, and it was up 253K new jobs created, rather compared to an estimated 185K based on consensus. So again, obviously, surprising on the upside. Points to rather resilient US labor market. The unemployment rate is now officially 3.4% versus the consensus estimate of 3.6%, which is apparently the lowest since 1969 in the US. Wow, that was even before I was born, right? The average hourly earnings on a month-to-month basis is up 0.5% versus an estimated 0.3%. On a year-to-year basis, is up close to 4.4%. Again, hourly earnings is again continues to impress. Now, the good thing is, of course, the labor force participation. That means looking at the pool of people between 25 to 54 years old who are out there looking for jobs is now up to 83.3%. Okay, let me just redefine that. Participation rate is basically people who have jobs, who are looking for jobs out of the entire possible population. Okay, it's 83.3%. Again, this is higher since 2008. So we've got kind of a mixed bag. So obviously, more jobs are being created. Hourly earnings are up, so wage inflation is still quite stubborn. But you have the other structural impact here, which is that more people are joining the workforce, which will then, I guess, hopefully cool wage inflation going forward. Bit of a mixed bag, but net is that US labor markets are still quite strong. Now, the credit crunch is real. It all happened, or rather, it all started as SVB, Silicon Valley Bank. But what has been happening now is, of course, with higher borrowing costs, banks are more selective in how they, I guess, give out loans to clients. So client quality needs to be higher. There is a positive correlation between tightening lending standards as well as exchange credit. So as you can see in the orange line, this is the net share of loan officers saying standards are tightening. So obviously not an empirical or numerical number, it's more of a survey kind of thing, so a bit subjective. But as you can see, there is a positive correlation in the sense that when standards are tightened, then the number and amount of loans being given out will change. All right, there is obviously a lagging impact simply because that needs to take time. So the change in the volume and number of loans will happen after the standards are tightened. But already we can see that there is stress in the banking sector. So SVB was the first one, a little bit of a niche player, in a sense that not only, but the vast majority of depositors were hedge funds and so on and so forth, and they lent out to startups. So high risk, not very traditional kind of banking. But the problem is that stresses in the banking system tends to snowball. All right, so obviously not an outlier. Contingent has spread. So you've got names like First Republic, obviously, PacWest right now, Western Alliance, First Horizon, all these the kind of small to mid-cap lenders that nobody's ever heard of outside of the US. Very regional kind of players. They don't offer a full suite of banking products. But as you can see, this is leading to a perception that the US banking system is under assault. Over the weekend, JP Morgan, not this weekend, but last weekend, JP Morgan had taken over First Republic This is in the latest rescue. Obviously, previously SVB and all that also had some kind of government intervention. Now, as a point of reference, if you guys remember, you probably only remember if you're today 60 years old and above. In the US, you had this savings and loan crisis during the Reagan era, 1980 to 1989, in which more than 1,000 small and mid-sized lenders in the US actually failed. Ultimately, the US government had to bail the vast majority out. And US taxpayers were on the hook to pay as much as 124 billion US dollars at that point in time, at 124, not even adjusted for inflation, to resolve all the issues. All right, so we've only seen a couple of names, but of course, depending on how tight the lending standards are and how high the Fed funds rate is going to remain and for how long, then this is probably not going to be the end of the story. Okay. All right, but just to kind of put this in perspective, we are not talking about JP Morgan or Citigroup going down the drain. This is not a great financial crisis, yeah. So having a couple of, not couple, but even if the hundreds of small to mid-sized lenders failing, not really. I think it's going to be a problem, but I don't think it's going to be the end of world kind of problem. So let's put that in perspective. The other risk factor here that we want to talk about is that you have got a debt ceiling issue again. This was not an issue for the last few years, simply because Donald Trump, a Republican, was in office. And of course, that was the COVID era. The Democrats in Congress were actually quite, I guess, pretty good team players. So they didn't raise any kind of hackle or any kind of fanfare. So their debt ceiling was actually raised 3 times during the Trump administration era. But obviously now politics is very polarized. You have President Biden, who is a Democrat, and of course the House is held by the Republicans through a very, very thin majority. And that's a key problem here. Because with such a thin majority, the House Speaker, which is McCarthy, only narrowly got his job, because you need to have all the Republicans in the House of Congress to vote for the House Speaker, right? So he only got his job after he was able to corral all the Republicans. And of course, Republicans, you've got the moderates, you've got hardlines, right? Like the Freedom Caucus. So essentially, Speaker of the House is beholden to hardline Republicans, and the hardline Republicans want the Democrat administration to reduce its spending, or they would not increase the debt ceiling. Again, a show of brinkmanship, very irresponsible, but that's politics for you. So there is a higher probability of government shutdown this year compared to all previous years. Now, again, in 2011 and 2013, there were shutdowns in the US government. So if the debt ceiling is not raised, US government has run out of cash, you need to shut down parts of the US government, or people will have to go without being paid. So people like in the military, they're going to have to do their jobs without being paid. So essential services. But if you're a US government civil servant and you're not considered essential, then basically you'll be go home. You got no pay, so no need to work, but basically you got no money, right? So this is going to be a huge problem. Obviously, not a great time, considering we are heading into the second half, and obviously the inflation fight is still on, and we are still going to have the recession. So the gig is still on. The recession, not cancelled, not rescheduled. Not a great time to have this political issue happening. Now, the last risk factor, which I only just found out today, was actually the weather. The US National Oceanic and Atmospheric Administration has got a 62% probability, or rather says there's a 62% probability of extreme weather between now and July. And the probability actually rises to 80% by end of September, the El Nino effect. And what does extreme weather look like? Storms and floods in California and the US South. So we're talking about Texas, Alabama, Mississippi, possibly Florida. So again, you got the tornadoes and all that, yeah. Droughts in certain parts of Asia, as well as heavy rain in South America and Africa, which obviously will have a huge impact on food, right? Too much rain, too little rain, the impact on food. And of course, Texas itself has got both oil rigs as well as land-based oil, refinery facilities, the ports, and so forth. So energy output will also be impacted if the tornadoes and heavy rain, do impact the oil production infrastructure in the US. All in, the IMF, the International Monetary Fund, says that a strong El Nino effect can add up to 4% to commodity price inflation. Okay, so these are a couple of risk factors that we want to kind of take note of as we head into the second half. There are some other anecdotal evidence that corporate profits are turning. The forward PE ratios of some of the S&P 500 sectors are actually showing positive growth on a year-to-year basis. But it's forward PE, so it's forecast, right? We suggest that current prices have already built in or have already taken into account the slowdown. All right, so gonna leave Sunny to round up the technical stuff as well as the economic indicators.
Okay, thanks Ben for the detailed sharing. So we have that 25 basis point hike which Ben touched on earlier. So I think what we want to discuss here is what is the market expectation. So of course, when we saw last week, the probability of the Fed fund rate pricing in the 25 basis point hike, that was like 90% priced in already. So the hike of the 25 basis point is priced in even before the announcement. But what happened after the announcement was the general market, the S&P 500, the Dow Jones Index, or even the Nasdaq actually went down after the press conference with the Fed chair. So what happened then was that I believe the market was expecting a sort of an announcement from the Fed chair that this will be the last rate hike and going forward they will pause. But they are not getting this message from the Fed, and the message was they might pause sometimes in the future, which was sort of repeated from what was said in the previous few press conference. So it was something that is not what the market wants, and hence there was a pullback from most of the major indices in the US. Now, the next Fed announcement will be on 14th of June, as you can see. So most of the expectation now, which is still in the very early days, is still pricing in a pause at 90% of a probability right now. So we wait to be see as this probability can change over time depending on the economic data that's going to be published between now and 14th of July. Okay, so talking about economic data, the big and important data that will come out this week on Wednesday, May the 10th, will be the inflation numbers. Of course, last week we have the better than expected non-farm payroll numbers, which may contribute to persistent inflation, like what Ben touched on earlier. So this will be a key data to watch for this week. So month-on-month inflation is expected to increase by 0.4 compared to the previous reading of 0.1. Inflation headline numbers year-on-year is expected to come in at 5%, same as what was announced previously, which is also 5%. But of course, everyone will be zooming in on the core inflation rate year-on-year data, which came in at 5.6% the previous round, and we are expecting it to come down to 5.5%, a drop of 0.1%. So we want to have an inclination that the data at least shows that inflation is on a downward trend. So we don't want the numbers to be higher than the previous number. Of course, with the non-farm payroll number last week better than expected, surprises are expected to happen along the way of the inflation rate announcement. So do keep an eye on all this economic data, which will sway the market quite a bit going forward. Okay, so on the earnings data, so far most of the S&P 500 companies have announced their earnings, and they are overall coming in slightly above analyst expectation or market consensus. So this week we are expecting PayPal to announce today, and tomorrow we have Airbnb. On Wednesday we have Walt Disney. So these are some of the key companies that are announcing their earnings this week. So let's move on to the charts. So let me look at the US indices first. So this is the Dow Jones Index. As you can see over here, we have a very big green candle on Friday because of the non-farm payroll data, which means that the economy is not in trouble yet. The job numbers are still positive, hence we have this big green candle. However, this big green candle of an increase in 1.65% close of last week is capped at the mean of the Bollinger Band, which is the 20 days moving average at the level of 33,743. The closing was 33,674. So that means that it is not above the upper limit of the Bollinger Band. Hence, the downtrend that we see for the past week is still very much intact. So this also happened during the FOMC announcement of the 25 basis point hike, with no confirmation that this is the final hike for this year. So market take it as a negative and cross below the 20 days moving average, as well as move towards the lower bound of the Bollinger Band. So I would say that the downtrend that you see in the past week is still intact, because if you look at the indicators as well, MACD is still negative. You look at the MACD line and the signal line, it seems to me that it is diverging away from each other. That means the downtrend momentum might gather speed, although we have one data point on Friday shows that the data is weakening. Okay, but that's one data point to look at. On the whole, for the past 1 week, the trend looks like negative. And the MACD now is above the zero baseline. So any crossover of the MACD line and signal line below the zero baseline means an acceleration in the negative downtrend momentum as well. So RSI, the previous week, we saw the reading at around the 41.26 or 43.26 level, below the 50-point level. So momentum is weak for the past week. However, on Friday, we have a little bit of nudge above the 50-point neutral mark. So the latest reading on Friday is 52.53. So slightly positive, but the momentum is still weak. So this may actually change or move down another 2 or 3 points below the 50-point neutral mark. And we are also quite a fair bit away from the 30-point oversold zone. That means this downtrend might have a bit of a way to go. So where will it likely go? I am at least predicting in the near term, if you connect the low of the October as well as the low in March that you see over here, a green uptrend line, this is where support might likely come in. If the uptrend that we see since the low of October is going to continue, the support is likely to come in around the 32,573 level, okay, which is also somewhere the low of the December last year. So this part over here, you can see that there's a bit of support and consolidation going into this year in January. So this might come in as a support level for the Dow Jones Index, at least for the near term, coinciding with the uptrend trend line that you see over here in green. So that's my take on the Dow Jones Index. Next, let's move to the S&P 500. So S&P 500, a lot of technical analysts are telling us that, okay, you see this double top formation. So this is likely going to be a very strong resistance level, because a double top formation is a bearish kind of formation. And if prices were to test this level, it's likely going to retrace downwards. So S&P 500 also have a big green candle last week with a closing of up 1.85% last Friday. So the market is to retest this red line again, which is the 4,195 or 4,200 handle. I am more inclined to say that this double top formation is likely to hold for now, and hence this is the supply zone where a lot of sellers will come in again, either to take profit or even to short the market downwards. So where is support likely to come in? Of course, we have an uptrend line also connecting the low of October last year with the low of October in March this year. So the green uptrend line is likely going to provide some support for the S&P 500. However, during the December period of last year, the consolidation period was somewhere over here around the 3,800 level. So this the pullback for the S&P 500 may likely be greater than the Dow Jones Index. Looking at the indicators, MACD is still looking negative. The latest reading at negative 7.43. That means the MACD line is below the signal line. So this trend is telling us that there's negative momentum in the S&P 500 index right now, and it's likely going to continue downwards because it's a negative number. Although we see that there's a sort of a improve in the momentum, that means the negative momentum is getting slightly lesser because of the shorter bar of the MACD histogram downwards. But then generally for the past 1 week at least, it is still on a downward trend, as the MACD is likely going to diverge away from the signal line going forward, and then cross below the zero baseline. The acceleration towards the downside will get faster. So the RSI reading, last week we have a reading of 45.27 on the lower side. On Friday, we have a little bit of a push up to the 54.81 level, just 4 points above the 50-point neutral mark. So that is just a one data point, but overall as a trend, you can see that the RSI peaked around the early part of April at around the 60-point level, which is the 14 days moving average of the RSI reading, which is 55.96. So if you read the moving average of the RSI for the past 14 days and compare with the current reading, it is still lower than the past 14 days reading. So that means that it's still biased towards the downside. So S&P 500 with MACD and RSI pointing to us that there's weak or negative downtrend momentum, it is likely to trend lower. Although we have a big green candle on Friday, I believe it's going to trend lower and it's likely going to retest the 4,000 handle and probably breach that level just slightly below around the 3,900 level, where we'll start to see some of the support coming in for the S&P 500. Then next week, let's move on to the Nasdaq Composite Index. Now, Nasdaq Composite Index, the resistance that we are seeing is at the 12,269 point level, which is the peak that we saw this year in, I believe this is, let me move my zoom bar. Okay, so this is around the February period, the high that we saw. And then early part of April, late part of March, we also see this coming close to this year-to-date high again and was rejected by this level, and we retested in mid of April. And now this is the third time that we are testing early part of May, or even the fourth time with last Friday gains. So this is a resistance level that has been tested 4 or 5 times already this year, especially in the past 2 months or so, I would say. So this resistance level has been tried and tested and still likely to hold on to this resistance level, which is also the upper bound of that Bollinger Band. So 12,269 point will be the resistance to watch. I think short-term traders will be salivating at the opportunity to take a short position at this level because the signals are pretty clear to see that this is a very important resistance level to watch. On the indicator side, MACD is reading at negative 5.2, so it's in a downtrend, and RSI is reading at 54.15. Last week low was around the 48.64, and then the moving average is 54.15 for the RSI indicator. So a bit of a positive momentum on the RSI, so a bit of a contradicting point to the MACD indicator. So not very not providing the same signal between the RSI and the MACD indicator, but it looks to me that both are trending towards the weaker side. That means if we have a pullback on the Nasdaq Composite Index, and then the support level will come in around the double top formation that you see over here in December last year. That's 11,571 point level for the Nasdaq Composite Index, which may find confluence with the uptrend line that we have plotted over here, which is the low in December as well as the low in March. So this confluence point at 11,571 will be likely the support for the Nasdaq Composite Index. Let's move to the Asian markets. Let's look at the HSI markets. HSI index still pretty in a much of a range bound, as you can see, not much of a big movement here or a breakout or a bull run that we are expecting. However, I am more positive towards the Asian market side as compared to the US side. And if HSI, you're looking at any support level, that would be the year-to-date low that you see over here, this green line, which is at the 18,829 points level. I'm still waiting for it to come downwards to retest this level and then form a double bottom formation, which would be a bullish kind of a signal to re-enter the market on the HSI index. The HSI index currently now is retesting the 20 days moving average, which is the orange line in the middle of the Bollinger Band at 20,150 points. So not much of a direction it is showing at. It is just trending around the 20 days moving average. On the MACD side, as you can see, not much of a momentum. Although the MACD reading is negative 7.05, the lines are showing no sign of a direction and looks likely to move sideways. So we are waiting for some kind of trigger or catalyst to bring the index slightly higher or even lower for an opportunity to arrive. The RSI reading at 51.22, just 1 point away from the 50-point neutral mark, also telling us not much of a direction to play with for the HSI index right now. Hence, my take on the HSI index would likely be range bound, at least in between what the Bollinger Band is saying. So if you are a short-term trader and you want to take a short position, you will be looking out for the upper bound of that Bollinger Band, which is 20,781 points. On the lower side of the Bollinger Band, it is 19,518 points, and year-to-date low 18,829 points. That is the level to watch. Next, let's move to the STI index. So STI index, in line with what happened in the US last week, has also been trending downwards. So the 3,300, which we have talked about a lot of times on the weekly market review, is proving to still be a formidable resistance level for the Straits Times index. So today we are also seeing a negative movement on the Swiss Times Index as well as the trend that you see in the past 2 weeks. So on the MACD indicator side, the reading is negative 6.97. You can see that we have been in the negative zone for the past at least the past 10 trading sessions already. The MACD line is also diverging away from the signal line, and we are now on the verge of crossing the zero baseline on the MACD indicator. Hence, if we cross below, the downward acceleration in the Swiss Times Index might prove to go lower and retest the low that we see in December here, which is around the 3,225 points level. On the RSI, it is now below the 50-point neutral mark at the reading of 44.87. So that means that there's very weak momentum in the Swiss Times Index right now. So I believe the STI index will likely move lower, and 3,200 points will be my target for the next few weeks for the STI index. So that is my take on the indices this week. Anything else, Benjamin?
No, that's good. So I guess it's already coming to May. I mean, it's already May. So we're heading into the second half already. Right. So I guess things are gonna be a little bit choppy going forward. Yeah, choppy going forward, but closer to, I don't know, start of 4th Q, I guess then we can start thinking about dipping back into the water.
Yes, that's the consensus of what the analysts are saying also.
Yeah, and that's when the depth saving thing will, okay, but anyway, we will cross the bridge when we come to. So, ladies and gentlemen, you heard it here first at the weekly market review with Sunny and myself. So have a great week ahead.